There is a type of job that has always felt safe. Not glamorous, not exciting, but safe. A profession built on complexity, regulation, and the kind of human judgment that felt impossible to automate. You needed a degree. You needed years of training. You needed to understand the specific rules of specific countries, specific clients, specific situations. For 100 years, accounting and tax advisory was that job. Then, in 2025, the 4 largest accounting firms in the world quietly started replacing it. Not with cheaper labor, not by moving work offshore, with artificial intelligence agents that work around the clock, handle thousands of cases simultaneously, and do not require a salary, a pension, or a desk. Big 4 graduate openings fell 44% in a single year, not because the firms were struggling, because they had found something cheaper than a junior accountant. The safest, white-collar job in the world just became the first one to go. The story most people tell about accounting and artificial intelligence goes like this. Artificial intelligence will help accountants work faster. It will handle the boring parts. The humans will move up the value chain and do more advisory work. Everyone wins. That story is half true. And the half that is missing changes everything. In January 2026, Deloitte announced it was scrapping its traditional job titles: analyst, consultant, manager, the progression that had defined careers at the firm for decades, gone. Replaced with a new structure built around the assumption that artificial intelligence agents would be handling the work those titles used to describe. The same month, the Financial Times published an analysis of more than 50,000 job listings from Deloitte, Ernst and Young, KPMG, and PricewaterhouseCoopers. The finding was clean and unsettling. Artificial intelligence-related job postings made up almost 7% of Big 4 listings in 2025. Audit roles made up under 3%. The 4 largest accounting firms in the world are now hiring more artificial intelligence specialists than accountants. This is not a future scenario. This is a Financial Times analysis of what actually happened in 2025. The pyramid that built the accounting industry for 100 years is being taken apart, and it is being taken apart from the bottom. The accounting pyramid has survived every technological wave since it was built. In the 1980s, the spreadsheet arrived. Lotus 1, 2, 3, and then Microsoft Excel. Accountants who had spent years doing calculations by hand suddenly had a machine that could do it in seconds. The prediction at the time was obvious. Fewer accountants needed. Jobs would disappear. The opposite happened. More accountants were hired than ever before. Because the spreadsheet made it possible to do more analysis, serve more clients, and expand into new services. The pyramid did not shrink. It grew. The same pattern repeated with the internet, with enterprise software, with cloud accounting platforms. Every wave of technology made junior accountants more productive, and more productive junior accountants meant more revenue, which meant more junior accountants. The pyramid held for 40 years because every new tool augmented the human at the bottom, made them faster, more capable, more valuable. The artificial intelligence agents of 2025 do not augment the junior accountant. They replace the work entirely. That is the difference that breaks the pattern. Not faster humans, no humans. Deloitte's Zora does not help a junior accountant process invoices faster. It processes invoices autonomously, without a junior accountant in the loop at all. The spreadsheet made the human more productive. Zora makes the human optional. For the first time in 100 years, the pyramid has found a reason to shrink. On March 18, 2025, Deloitte launched Zora AI, built in partnership with NVIDIA. The platform is a suite of ready-to-deploy agents that can autonomously execute complex business functions. Deloitte's own estimate is a 25% reduction in costs and a 40% increase in productivity for finance teams. On the same day, Ernst and Young launched its own platform. The EY.AI agentic platform embeds more than 150 specialized tax agents to support 80,000 professionals worldwide. EY's projection is more than 3 million tax compliance cases handled within a year. 150 AI tax agents, 3 million cases, no junior tax staff required. KPMG committed $2 billion over 5 years to artificial intelligence development, targeting $12 billion in added revenue from AI-enabled services. In June 2025, KPMG launched Workbench, a multi-agent environment that mirrors the structure of a human audit team. PricewaterhouseCoopers deployed GL.AI, an artificial intelligence agent that handles journal entry processing and general ledger review. The tasks GL.AI automates are precisely the tasks that previously justified the existence of junior accounting staff. Journal entries, invoice processing, tax research, compliance review, document summarization. Those 5 tasks represent the majority of what a junior accountant does in their first 3 years. All 5 are now being automated at scale by the 4 largest firms in the world. Thomson Reuters reported in 2026 that tax research had reached 69% AI adoption across accounting firms. Document summarization was at 57%. Stanford research confirmed that junior accounting roles fell 16% in approximately 2 years. And Ernst and Young has delayed graduate start dates 3 years in a row, with 2025 hires not starting until March 2026. 3 years in a row, not a one-time delay, a pattern. The Wolters Kluwer Future Ready Accountant report found that AI adoption in accounting firm jumped from 9% in 2024 to 41% in 2025. In 1 year, the tipping point did not arrive slowly. It arrived all at once. Here is the part that almost no one is talking about. The Big Four are not making this transition because the technology convinced them. They are making it because their clients demanded it. A Deloitte survey of chief financial officers published in the first quarter of 2026 found that 54% named agentic artificial intelligence as their top priority for the year. Not a priority, the top priority. The clients are pulling the firms into automation faster than the firms would move on their own. Large companies no longer want advisors cautiously experimenting with artificial intelligence on the side. They want firms that have redesigned their operations around automation. They want to know that the invoice processing, the tax research, the compliance review is being handled by systems that do not take sick days, do not make errors, and do not cost $70 an hour. Ernst and Young's global managing partner for growth and innovation, Raj Sharma, described the shift plainly. Agentic artificial intelligence fundamentally transforms business operations, not improves, transforms. And there is a second overlooked dimension. The firms replacing junior humans with artificial intelligence agents are simultaneously creating a new kind of junior role. Not the junior accountant of 2021, the artificial intelligence overseer of 2026. Someone who manages the agents, reviews the outputs, catches the errors in edge cases, and translates the results for clients who still want a human voice in the room. The pyramid is not disappearing. It is being rebuilt with a different base. They did not automate accounting. They automated the part of accounting that used to require a person. The accountants building durable careers in 2025 and 2026 are not the ones trying to do journal entries faster than an artificial intelligence agent. They have already accepted that they will never win that race. PricewaterhouseCoopers published its Global AI Jobs Barometer in 2025. The finding: workers with artificial intelligence skills command a 56% wage premium in business and finance roles. Not a small advantage, 56%. The firms restructuring fastest are also the ones growing fastest. KPMG is targeting $12 billion in new revenue from AI-enabled services. That revenue does not come from replacing humans with machines and charging less. It comes from offering services that were previously impossible at a scale that was previously unthinkable. The signal is in what the Big Four are actually spending money on, not on junior accountants. On the people who can build, manage, audit, and improve the artificial intelligence systems, doing the junior work. That is the new bottom rung of the pyramid. The accounting profession is not ending. The entry point is moving. And the people who find the new entry point first will be the partners of 2035. If you want to keep seeing the next layer before it becomes obvious to everyone else, this is where that happens. Every week. Before the mainstream catches up, there is still a type of job that feels safe. Complex, regulated, requiring judgment, requiring years of training, requiring a human in the room. That description still fits accounting. But the work that used to sit underneath it, the journal entries, the invoice matching, the tax research, the compliance review, that work is being handed to systems that do not need a salary or a career path. The pyramid held for 100 years. In 2025, it started to change shape. Deloitte scrapped its job titles. Ernst and Young deployed 150 tax agents. KPMG committed $2 billion. PricewaterhouseCoopers automated the general ledger. All four firms are now hiring more artificial intelligence specialists than accountants. This is not a warning about what is coming. This is a description of what already happened. The first white-collar industry to be reshaped by artificial intelligence at scale was not the one people expected. It was the one everyone thought was safe. The pyramid was always there. Now you can see what it is becoming.